Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be discussing dividend stocks. So ask yourself, are you looking to add some new dividend stocks to your portfolio? Well, today we're going to be covering 5 of the best dividend stocks going ex-dividend October 15th through the 19th, 2018. So if you are brand new to the channel, I do make stock market, personal finance, and real estate investment videos weekly. So consider subscribing for future videos. So in today's video, we're going to be covering 5 stocks. We have ticker symbol ACN. This is the Accenture. Their sector is within the services. Their industry is management services. We have ticker symbol CL. This is Colgate. Their sector is consumer goods. Their industry is personal products. We have a ticker symbol HRL. This is Hormel Foods. Their sector is consumer goods. Industry is meat products. Pretty well-known company. Ticker symbol XOM here. This is Oxford Industries. Their sector is consumer goods. Their industry is textile, apparel, clothing. And last, we have ticker symbol RPM. This is RPM International. Their sector is industrial goods, and their industry is general building materials. So those are going to be the 5 stocks we're going to be discussing in today's article. All of these stocks were initially screened. Well, I screened 40-some stocks. These were picked out because they all have starting yields over 1.5. They've all had rising revenue, net income, free cash flow positive over the last 5 and 10 years. They're moving in a good positive direction. Their forward PE is expected to be less than their current PE, meaning that the next year earnings per share are expected to be greater than their current earnings per share. And all of these stocks have grown their dividend for at least 5 years or longer. Some of them actually have been raising their dividend for some 40 plus years. So we got a good number of stocks this week to discuss. Now we're going to be talking about ex-dividend dates, dividend dates, price comparison to the yield, PE comparison to the industry, the S&P 500, payout ratios, and a little other statistics as well. So if you haven't started your investment journey, my recommended brokers are M1 Finance for those who want to start a retirement account like a Roth IRA, and then we have Robinhood there. They're included in the link. And then I did create a free simple dividend calculator. You punch in the price, how much they pay out, and it kind of spits out, or however much you want to invest in a company over so long. It gives you a good rough estimate of how many dividends you would get paid and what your total equity would be in that position. So all these stocks are ordered by ex-dividends going October 15th through the 19th. So although they have like a number 1, 2, 3, 4, 5, they are not in that specific order based on any sort of, there's no value to it. It's just they're ordered by ex-dividends. So number 1 is ticker symbol RPM. RPM International owns subsidiaries that are world leaders in specialty coatings, sealants, and serving both industrial and consumer markets. Some of their products include roofing systems, sealants, corrosion control coating, flooring coating, and specialty chemicals. Industrial brands include a list there. So they do a lot. It's in the industry, it's in the general building materials and industrial goods. This stock's going to be going ex-dividend next Monday on 15th of October. So you would have to buy this one this Friday or prior to be eligible for that dividend payment on the 31st of October. Here we have their 10-year chart showing their dividend growth, their price, revenue, free cash flow, and net income over the last 10 years. So what I like to look at here is if you take these numbers divided by 10, that gives you their average growth per year over the last 10 years. So here, for example, their price is sitting at 301% over the last 10 years. So that's 30.1% on average per year return on your investment, plus you're getting paid out that dividend yield of around 1. Actually, it's pretty high now, 2.31 right now. So that's not including that dividend payout. That's actually removed from the price. So this price movement is 300% or 30% per year, plus you'd be getting that over 2% yield paid out to you. So interesting stock here, and you can kind of do the math here on the net income. 71% year over year increase on their net income, up 712.5% over the last 10 years. So very quick moving company. You can see a lot of growth here kind of going on. Now for their 1 year information here, they currently pay out 35 cents per share each quarter per share. You can see that they had a very nice rise from around 32 cents per share to 35 cents per share. That's a pretty good gain there. When you're looking at numbers as small as these, if we take the current minus the old, divide it by the old, that's a nearly 9.3% increase. And if we go back and just look at that 10-year graph here, so their dividend over the last 10 years has risen. You take 75 and you divide it by 10. That's an increase of around 7.5% on average per year. So pretty healthy increase there. They're currently priced at $60.59. Let's see if I can zoom in here for you guys. Their current yield is actually 2.31 because they did raise their dividend from now. They raised their dividend from that 32-cent point to that new 35-cent point, which actually puts their yield up 2.31. Still puts it a little bit slightly below the price. Their current PE is 28.18. Their forward PE is 20.11. Their price to book is 4.99, and their price to sales is 1.5. So when charted, it does show this current stock does have a higher price over yield, which may indicate it could be overvalued at this time. The stock is also trading above the industry average of 17.6. It's also trading above the S&P 500 PE average of 25.56. It is sitting below 60% payout ratio. It's currently sitting at 45.2% payout, meaning that if its earnings were to drop by some 50%, they could continue to pay out that dividend. Their payout ratio may drop to say 80, 90%, but at least they would be able to continue paying out their dividend, which is probably why they've had continued growth for the past 43 years since 1975. Their price to book here is at 4.99, which is slightly above that 3.0 value, where value investors would consider it a value. So overall, pretty healthy looking stock. Has been growing and paying out dividends for the past 43 years since 1975. So very strong growth stock as well as a nice yield, initial yield. 2.31 with a 7% on average increase on your dividend. So after 10 years, Rule of 72, you basically double your dividend payment in 10 years. So next, number 2, we have ticker symbol ACN. This is the Accenture. Accenture is a management and consulting technology service and the outsource company. The company has 5 operating groups: communication, media and technology, financial services, health and public service, and products and resources. Their ex-dividend date is next Wednesday, the 17th of October. You'd have to buy the stock on Tuesday or prior, hold it until the ex-dividend date, and then you'll get paid out on the 15th of November. Here, taking a look at their tenure, you can see that their price is up 431% over the past 10 years, or per year, it's about 43% per year on average. Their dividend up 192% over the past 10 years. That's an increase per year of 19.2% as of 10 years ago. Also, their net income, their free cash flow, and their revenue are both double digits there, 6.1%, 8%, and 12% there over the past 10 years on average per year. So very good growth company as well here. Here we're looking at their 1 year. So they currently pay out $1.46 per share each quarter, up from around $1.33. So very nice dividend increase there. They're currently priced at $1.69.92 with a dividend yield of 1.72. So here, this is pulled off dividend.com. Because they raised their dividend from 133 to now 146, that raises their dividend to a now 1.72, which actually puts them slightly below here. But I would say this is more valued, like fair value, than currently overvalued. But current yield, we've already covered that. Price to book right now is our price to PE ratio is 26.8. Forward PE ratio is 23.55. So their price to book is slightly high at 10.49, but this is a growing company, so the price of sales here is the main factor at 2.67. So when charted, does show the current stock does have a higher price over yield. I would say it's about flat, pretty valued. So the indicator would say about valued at this time. The stock is also trading above the industrial average of 24.9 and above the S&P 500 average of 25.56. It is sitting below 60% payout ratio at 40.4, and it's had dividend growth for the past 8 years. Their price to book value right now is at 10.49, which is above that 3.0 value, where value investors would consider a value. But this is more of a growth company, so I would focus more on the price of sales, sitting at a 2.67. So again, dividend yield 1.72. They pay out $2.92 per share. Very low payout ratio at 40.4. Now, they've had dividend growth for the past 8 years since 2010. Prior to that, they did cut their dividend because they went from an annual dividend payout of some 32 cents per share. They cut their dividend to 18 cents per share, and then they went semi-annual, so you would get 18 cents and 18 cents every 6 months, and that would total the 32 cents that they had initially paid out. So they try to just keep some of their cash more on hand during that pullback. Number 3, we have ticker symbol CL. This is Colgate Palmolive, and it's in a consumer product company that specializes in household and healthcare personal products. The company operates in 2 segments: and personal, and home care and pet nutrition. There's a lot of ands in there. So I was going to say Centrelink. Colgate offers hundreds of products and operates in over 200 countries throughout the world. The ex-dividend date is on the 18th of October, which is next Thursday, so you'd have to buy this one on Wednesday or prior. Hold it until Thursday, the ex-dividend date, where you would then have that payout on the 15th of November. So here we can see their 10-year chart. Price up 12.2% on average per the past 10 years. Dividend increases about 11% on average for the past 10 years. In the green, they have their free cash flow up 5.4% on average per year. It has taken a bit of a hit here recently. As of 2013, it has been on the decline, but it looks like 2016 it has begun to grow a little bit coming out of that, along with their net income and their revenue here. So it looks like they had a bit of a dip here between 2013 and 2016, midpoint 2016, 2017. They began to regrow their revenue and net income. So I've seen people label this one as a bit of a risky stock. You can see that there are other companies out there that have lost net income revenue during this downturn. You know, they didn't fully recover, such as General Electric, but Colgate is one of those that is slowly turning it around. They're not really in the negative, but they really haven't had a whole lot of growth in their revenue and in their net income for the past 10 years, but their price has remained pretty high during that time. So looking at their 1-year graph here, they currently pay out 42 cents per share each quarter. They're currently priced at $65.35. That gives them a current dividend yield of 2.57. So this is actually correct. They increased their dividend back in January from 40 cents to 42 cents. So their current dividend yield is sitting at about a 2.57, 2.51, depending on the day and where that price sits. Their current PE is at a 26.14. Forward PE is at a 21.6, and their price to sales is at a 3.6. You notice that they don't have a price to book here. That's actually because their liabilities and their assets kind of nullify each other and put them into a negative, meaning that the price to book value doesn't actually show up on the graph. We'll go ahead and show that on Y charts here in just a second. So when charted above, it does show the current stock does have a higher yield of a price, which may indicate it could be undervalued at this time. The stock is trading above the industry average of 23.4, the S&P 500 average of 25.56. It is sitting below 60% payout ratio at 55.6, so just slightly below that 60% payout ratio that I like to consider healthy. It's had dividend growth for the past 54 years. Its price to book value is not applicable because it's non-existent. I would say it's actually below, but its liabilities and assets kind of nullified each other. So let's go here and we'll jump and we'll take a look at Colgate. So here is where we saw their assets and liabilities. Now this one doesn't show it actually crossing over. Right now it's showing that their total assets and total liabilities are actually slightly below, but on the current math of where they're currently sitting quarterly, their liabilities have actually gone above their total assets, putting them at a negative price to book value. Whereas some of these other ones, if we take a look at RPM has almost double the assets. ACM has basically almost double the assets. Oxford, they're sitting almost triple the liabilities there, and Home Royal Foods sitting almost triple as well, a little bit over triple. So Colgate, one of those riskier ones, they hold a lot of liabilities in comparison to their assets. So kind of a risky stock there, but I know a lot of investors hold this within their portfolio because they've had dividend growth for the past 54 years, since 1964, but who knows how long that'll continue. And number 4, we have ticker symbol OXM. This is Oxford Industries. It is a producer and marketer of branded and private label apparel for men, women, and children. Oxford provides retailers and consumers with a wide variety of apparel products and services to suit their individual needs, such as Oxford brands. It also includes exclusive licenses to produce and sell certain products categories under the Tommy Hilfiger, Nautica, and many others. Their ex-dividend date is on Thursday, October 18th. You'd have to buy this one on Wednesday or prior, hold it until the ex-dividend date. You would then get paid out on the 2nd of November. Here we can see their 10-year chart. Price is up 43% on average per year for the past 10 years, up 430% over the past 10 years. In the purple, their net income up 15.7%. They did have a bit of a dip here, you can see, during that pullback, but they've recovered very nicely and have had good growth. And the blue, dividend up 8.8% on average for the past 10 years. I would say that's pretty healthy. And the green, free cash flow is up 2.2% on the year, and the red here is their revenue. So the revenue is only up at a 0.5% increase year over year. So this one is, it's a ticker symbol OXM. So this sits in the consumer goods. It's in the textile, so apparel and clothing. Retail hasn't been doing that amazing, so this could be one to kind of be wary about as well. But I'll leave that up to you guys to kind of decide. So taking a look at their 1 year here, they currently pay out 34 cents per share each quarter. They're currently priced at $84.11. Their current dividend yield is 1.62. Due to the increase here, they paid out 27 cents per share. They bumped it up to 34 cents per share. That puts them at a new dividend yield of 1.62, which is right up in here. So current yield is over the price. Current PE is 19.38. Forward PE not too much lower at 18.34. Current price to book is at a 3.0 and a price to sales of 1.2. So pretty valued looking company right now. So when charted, it does show the current stock has a higher yield of a price, which may indicate it could be undervalued at this time. The stock is below the industry average of 42.3. It is also sitting below the S&P 500 average of 25.56. It is sitting below that 60% payout ratio. It's sitting at a 29.6% payout ratio and has had dividend growth for the past 8 years. Their price to book value is at a 3.0, which is basically, it's at that 3.0 value where value investors would consider it a value. So dividend yield 1.62, $1.36 per share each year. Current payout ratio very low at 29.6, and they did cut their dividend back in 2010. They cut it by 50%, but they just continue to raise it since then. So 2010, it looks like they needed the money. They cut their dividend, continued to go, and then started raising their dividend. They only cut it. They cut it in 2008, and then after 2008, 2009, 2010, then they started to raise it as of 2010. And number 5, and our last one here, is ticker symbol HRL. This is Hormel Foods. It's based out of Austin, Minnesota. It's one of the It's a multinational manufacturer and a marketer of consumer branded foods and meats products, Spam, many of which are among the best known and trusted in the food industry. The company leverages extensive expertise, innovation, and high contingencies in pork and turkey and processing and marketing to bring quality, value-added brands to the global marketplace. So their ex-dividend is next Friday, the 19th of October. You'd have to buy this one on Thursday or prior to be paid out that dividend on the 15th of November. So here, taking a look at their 10-year graph, you can see here in the green, free cash flow up 50% on year over year. Their price is up 39.6% over the past 10 years. Or 396% over the past 10 years, but 39.6% on average for the past 10 years. You can see as of 2016, this is their peak point. They came down hard in 2017. I did own this one for a while. And, disclaimer, I own Hormel Foods for a while. I'm not currently holding it. I don't plan on buying it within the next 2 to 3 days, but we shall, who knows. And, could have been a great buying opportunity back in 2017. You can see that as of that peaking point, they did come down for, back to a valued position and currently moving up 396%. Current dividend yield 305% over the past 10 years. That's an average year over year of 30.5. And the purple, net income up 239%. And in the red, their revenue up 40% or 4% per year over year. So good growth company there. Hormel Foods currently pays out 18 cents per share each quarter. They're currently priced at $40.54. That gives them a dividend yield of 1.85, 1.81 depending on the day. Their current PE is at a 22.65. Forward PE is at a 22.41. Price to book is at a 4.0 and a price to sales of 2.3. So when charted, it does show the current stock does have a higher price over yield, which may indicate it could be overvalued or fairly valued at this time. The stock is above the industry average, and the industry average for this industry is 12.3. So it is at a 22.65, which is, almost double the industry average. The S&P 500 is at 25.56, so it is sit below the S&P 500 average. It is sitting below a 60% payout ratio at a 42.9, and it's had dividend growth for the past 51 years since 1967. They have never failed to raise their dividend for the past 51 years, and I would say this is fairly valued. So price to book is at a 4.0, which is slightly above that 3.0 value, where value investors would consider it a value. Dividend yield 1.85 in that range. They pay out 75 cents per share each for the entire year per share. Their current payout is at a 42.9, very healthy, and again 51 years for the growing their dividends. So that is basically it. I hope you guys did enjoy the article. If you guys ever want to visit my website, it's always in the description below. I always have the newest article in the description and also in the comment section. So if you guys want to head over to my website here, check it out. If you'd like, you can also share it with your friends if they're dividend investors trying to get somebody interested in some dividend stocks. Share it over on Facebook, Twitter, all your other social media platforms. And of course, I am not a financial advisor or tax professional. The information in these videos is provided for fun and entertainment. If I had to look over every single one of these stocks, start with RPM, ACN, Colgate, OXM, and HRL. I looked over these, and I really like RPM, but I would say that it's very highly priced right now in comparison to its value. So I actually think Hormel Foods is actually a pretty fairly valued price right now. It's not too high, it's not too low. You're getting it within good price to book, price to sales. PE, you'd have to kind of look into that and see if that's pretty normal. But it's a dividend growth company, and they just have a solid history of continuing to pay out those dividends time over time, recession or not, and they just kind of recover through the recessions. We can actually, we won't go over that, but that is it for this video. I hope you guys did enjoy the video. If you are brand new to the channel, I do make stock market, personal finance, and real estate investment videos weekly, so consider subscribing. If you did like this video, remember to give it a thumbs up. I really appreciate it. Share it with your friends, and of course, thank you all for tuning in. I will see you next time. Have a great day. Bye.